Have you ever stared at a stock chart and just felt lost? Like you're trying to read some kind of secret code with all those jagged lines going up and down? Well, today we are going to decode it. We're going to find a surprisingly simple way to see the map hidden in the market's every move.
And believe it or not, the key to understanding all of this is to just think about a bouncing ball. Yep, that's it. A simple bouncing ball. This one little analogy is going to unlock the whole thing for us, so stick with me here.
All right, so imagine that our bouncing ball is a stock's price. What's the first thing it needs? Well, it needs a floor to bounce off of, right? In the world of trading, we call that very floor support.
So what is support, really? It's just a price level where buyers suddenly get very interested. They see the price falling and they start to think, you know what, that's a good deal. And they start buying. That rush of demand, that buying pressure, is what stops the price from falling any further and actually pushes it back up.
And this is exactly where our bouncing ball analogy comes to life. Just picture it in your head. The price is falling, and then bam, it hits this invisible floor made of buyers and bounces right back up. That's why we say it supports the price.
Let's put a number on it to make it real. Imagine a stock drops to, say, 100 rupees and then bounces. Then a few weeks later, it drops back down to 100 rupees and bounces again. That repetition is what matters. The market is basically shouting at us that for now, 100 rupees has become a solid support floor for that stock.
Okay, so if our bouncing ball has a floor, it's got to have a ceiling too, doesn't it? And in the market, that ceiling has a name, resistance. Let's take a look at how that works.
Resistance is, you guessed it, the complete opposite of support. It's a price level where the sellers start to take over. They see the price climbing and they think, all right, this is getting a little expensive, good time to sell. And that wave of selling is what overpowers the buyers and pushes the price right back down.
It is literally the ceiling for our bouncing ball. The price is rising, it's got all this momentum, and then, bonk, it hits that invisible ceiling of sellers and gets rejected, sending it falling back down towards the floor.
So for that same stock that was bouncing off 100 rupees, let's say it keeps rising up to 150 and then falls back, rises to 150 and falls back again. What is that telling us? It's telling us that sellers view 150 rupees as their exit point. That selling pressure creates a resistance ceiling that buyers just can't seem to break through.
So let's just put them side by side for a second. You've got support, which is the floor, and it's all about buying pressure when prices look cheap. And then you've got resistance, the ceiling, which is all about selling pressure when prices look expensive. They're just two sides of the same coin. They define the boundaries of the market's playground.
But what happens when the rules of the game suddenly change? What if our bouncing ball picks up so much speed on the way down that it smashes right through the floor? This is where things get really interesting.
So that support level, that floor we trusted back at 100 rupees, it's broken. The price is now trading below it. But here's the thing, that line on the chart doesn't just vanish. It's about to get a whole new job.
And here it is. That old floor becomes the new ceiling. Now, if the price tries to climb back up, it's going to hit that same 100 rupee level from below, and it will likely get pushed back down again. The psychology completely flips. And by the way, the exact same thing happens in reverse. When a resistance ceiling is finally broken, it often becomes the new support floor.
Okay, so far we've been picturing a room with a totally flat floor and a flat ceiling. But the market isn't always flat, is it? So what happens if the whole room is tilted? This is where our third and final concept comes in, trend lines.
A trend line is really simple. It's just a line that we draw on the chart to show us the direction of that tilt. Is the room tilting up? Is it tilting down? Or is it still flat? By connecting the dots where the price bounces, we can see the market's overall direction plain as day.
And if you think about it, the room can only really be tilted in three ways. You can have an uptrend, which we call bullish, where prices are generally climbing higher. You can have a downtrend, a bearish market, where prices are falling. Or, of course, the room can be flat, with the price just bouncing back and forth sideways.
Let's break that down just a bit more. In an uptrend, think of the whole floor as being tilted upwards. We draw our trend line by connecting the bottoms of each bounce, and since each bounce point is higher than the last one, we call them higher lows. That rising line now acts as a dynamic support. On the flip side, in a downtrend, the ceiling is tilted down. We connect the tops of each bounce, the lower highs, to create a falling ceiling, or what we call dynamic resistance.
Okay,
Let's bring it all home. We've got our floor, we've got our ceiling, and now we understand which way the room is tilting. We finally have all the pieces we need to read the map.
Because when you put all of this together, you realize these aren't just random lines on a screen. Support, resistance, and trend lines create a visual map of the market's collective mind. It shows you the constant tug-of-war between buyers creating that floor and sellers creating that ceiling. When you draw these lines, you are literally mapping out that battle.
And that, right there, is the real power. The next time you pull up a chart, don't just see a jagged line. Try to see the floor, see the ceiling, and see the tilt of the room. Because once you can actually see the map, you can start to make a much better guess about where the ball is going to bounce next.